Hey everybody, it's Pete. Good morning. Welcome to a new episode of Stocks for Breakfast. Today we're going to talk about something that I think helps to overcome one of the biggest challenges for new traders, but not only new traders, for experienced traders as well, which is holding good trades longer and having a very super specific entry and exit signal. One of the challenging things is we talk about all the time in the boot camp, especially for newer people, not even so much newer members, but newer traders who are still understanding the mindset, what we call hashtag trade like a pro, which is the thought process of winning trades versus losing trades and learning to not put too much emphasis on the losses and not getting too excited about the wins. However, the point that we want to make here is that for newer traders, it's usually a punch in the gut when you have a losing trade, and it's frustrating. And it's like, I don't understand. And in the book or in the course or in the YouTube video I watch, it says, do this and you make money, right? And that's frustrating. But again, the only reason that's frustrating is because you don't yet understand how to make more money on your winning trades. Because again, let's just discuss it as running a business, which is what it is. You're a money manager. You're managing your own money. You're in charge of leverage. You're in charge of risk, but you're in charge, most importantly, with creating profits. And in this case here, we're talking about trading profits. Now, run any business, there's going to be expenses. And in trading language, those expenses, other than software and those kind of things, are trading losses. So trading losses for us are a business expense. Now, let's shift it back into my world where, entrepreneurial, where I've been in business since 1988. There's expenses to run the business, and it's your job to run the business well to make profits. Now, when you have a business, you have lights and rent and employees and inventory and all that kind of stuff. If your business is making multiples and multiples and multiples of what those expenses are to run the business, it's not that stressful to run the business because you're making enough money to pay the bills, pay yourself, and those losses, meaning the light bill, the electric bill, the inventory bill, light and electric, same thing, right? They're not that big of a deal because if your bills are $3,000 a month and your revenue is $15,000 a month, you just pay the bill, right? You just run your business and you just pay the bill, and that's the shift you want to learn how to make as a trader. You want to get to the point where you're earning enough on your winning trades so that those acceptable losing trades are nothing more in your mind than just paying the bills. Those are just paying the expenses to run your trading business. And this is a big part of the boot camp. If you want to learn about the boot camp, click down. I'd love to see you on the other side, because it's trading, and profitable trading is so much more than just looking at technical indicators. It's so much more than just funding an account and having leverage and all of those kind of things, and 5 monitors and every software platform and every alert you can think of. It's in here and running the business properly. I mean, even just shift your thinking to what I just said. If you have a lot of revenue, the losses are nothing more than paying the bills. So what we're going to talk about today is a simple, easy to follow way that is non-subjective. So in other words, it's very objective. In other words, if it does this, that's what that means. If it does this, that's what that means. And we're going to look at 2 entry signals and 2 exit signals in the direction of a short-term trend. Now, remember what I said. Every single thing in trading has to first be thought of from the concept of thinking in the long term, which is thinking in your edge over time. And this is an area where a lot of traders struggle because they want every trade to make money, or they get upset. Well, that trade didn't make money. This process stinks, or this system stinks, or this edge stinks. But the truth is, we have no idea which of the perfect trades that we take are going to be profitable. We could put on exactly the same 2 trades. One does exactly what we want. One does exactly the opposite of what we want, but it's the same exact setup, the same exact edge. You have to remember what I'm about to show you. Any trading strategy works over time if it has a valid edge. So we're going to go back and use a simple system of candlesticks and 2 moving averages. So you could define it as a moving average crossover system, but it's really not, because we're taking it one step further, which is the faster part of that chart, to time entries and exits into half of the position. And what I'm talking about is the actual candlestick itself. So we're going to use the candlestick we're going to use a fast moving average and a slower moving average. And those three things combined will give us entries and exits into a very simple strategy. Now, if you want, you can add a third moving average, which will help define the trend a little bit deeper. But I have found over the years that this is a good way for somebody who is challenged right now with making decisions with conviction. It's very easy to follow. It's very easy to understand. But I want you to know it's not a complete strategy. What I want to give you today is I want to give you the, kind of like the raw materials to inspire you to add to this, the raw materials to think about, okay, that makes sense. I understand that there's a trend, there's an entry, there's an exit, there's scaling in, there's scaling out. You could take it deeper. It's completely up to you. You could use it in different timeframes. We also use this exclusively in the bootcamp as a profit-taking system. So in other words, you have really good profit targets. You have intraday targets. You have swing trading targets. And sometimes you get wiggled out on that one candle, and then it does exactly what you thought it would do. So if you want to tweak this a little bit as a profit-taking system, similar to what we have taught in the bootcamp, and especially in our coaching calls, you would use your normal indicators, your normal trading strategy to enter a trade. Then you shift over to this chart. And as long as the market's trending, again, moving averages work best when the market's trending, you would shift over to this and use this as a method to hold winning trades longer. So we're going to shift over to the charts. We're going to take a look. I'm going to explain it. And if you have any questions about this specific strategy, about this specific methodology, leave me a comment below. I'd love to hear your feedback. We can go back and forth. If you find this video helpful, definitely click down, give me a thumbs up, and absolutely subscribe so you get updates. And if you want to go deeper and then want to learn with me for the next 30 days in the bootcamp, it would be awesome for you to click down and at least click through and see what's included. All right, so we're going to head over to the charts. We're going to take a look at the moving averages that I use first. It's a very common question. Is I am using the 10-period moving average and the 20-period moving average, and they're both simple moving averages. Now, I get a lot of questions. Why aren't you using an exponential on the faster one? You'll see why in a second. It's literally because I want the moving average to be the averages. I don't want it to be faster because, as you're about to see, we are using the candlestick itself as the faster indicator within this quick strategy. So what we're looking at here is the 10-period simple moving average, the 20-period simple moving average, and basic candlestick charts. So what I want to get across first, and this is what you want to write down, you want to write down that the 20-period moving average is the trend that you are trading. So whichever side the 10-period moving average is and whichever side the candlesticks are on, when they're on the same side, you're trading in that direction. So in this case here, right in this moment, this is the trend we're trading. So as long as they're both above that, that's the current trend. Now here is the, I'm going to use the exit first to explain the strategy, because on this particular chart, it's easier to understand. So the first signal, which in this case, because we're trading a little bit longer time frame, we're using 20-period moving average, we're trying to capture a little bit bigger move. The first signal, the first entry signal, is when the candlestick on your time frame closes on the opposite side of the 20-period moving average. So that's a lot of words, right? But it basically means this. Let's assume that this is where we are, and right here, this candlestick right here closed. This is a red candlestick because it opened up here and closed down here, closed on the opposite side of the 20-period moving average. So if you were entering a trade in this instance, that would be your first entry. Your second entry is when the moving average, the 10-period moving average, does the same thing. When that crosses over the 20-period moving average, that's the second entry. So you can see here is your first entry. And then roughly 3 or 4 days later, depending on this exact candle, looks like here, 1, 2, 3, 4 days later, you would be adding to that position for your second piece. So I just want to go over it one more time just to make sure that it's crystal clear. That's the whole point, right? This is the main trend, the 20-period moving average. This is the current momentum on the 10-period moving average. And this is the candlestick. The first entry is when the candlestick closes on the opposite side. In this case, it would be a short sale. We'll do examples of buying in a second. When the candlestick closes on the other side of the 20, the second entry is when the moving average closes on the opposite side of the 20. Now, the obvious question is, when do you get out of the trade? And the answer should be obvious, right? When the opposite happens. So in other words, when the price closes on the other side of the 20 period moving average, and then when the candlestick closes on the other side of the 20 period moving average. So what this is allowing you to do is it's allowing you to make very clear, non-subjective decisions. It is fact, it's objective. This is exactly what we are doing, right? So let's go into, let's say we'll look at Goldman Sachs, and we'll use this as an example for holding, because this has been a little bit challenging to not get shaken out here if you're only looking at the price action. So in this particular instance, this candlestick right here at the beginning of November, when it closed on the other side of the 20 period moving average, that was entry number one. Okay. Entry number two is here. So let's see, this is November 5th. This is November 11th. So 6 days later, when the 20 period moving average gets crossed by the 10, so the 10 is crossing over to the other side, that is the second entry. So really, what's the biggest advantage of this? You're not entering the second piece of the trade until you have confirmation that it's moving in your favor. And you get that confirmation because of the slower moving or the slower price action, which in this case is the 10 period moving average, crosses over a little bit later. So what's beautiful about this is you can see now from these two entries, which the second entry is November 11th, and the price was 202.68, the 10 period moving average and the candlestick, neither of which closed or crossed to the 20. So this is just in this simple system here, 202 to 265. That's a $63 trade just by using this simple basic foundation of price action. So the question now is, when would you exit this trade? Now, the feedback you're going to get is, well, if it pulls back and you have to wait for it to get all the way down here, you're giving back all those profits, right? That's obvious. So you need to determine, are you trading the system flawlessly in exchange for bigger moves? And I want to tell you that any trend following system, which is essentially what this is, any trend following system is going to have drawdowns, meaning it's going to pull back and paper profits in exchange for the bigger move. So you could make a determination, is there a dollar amount you like? Is there a price target you like? But again, I can't stress this enough. If you are trading to learn to be flawless in your trading, if you're trading to get the habit of following a system flawlessly, you should follow the system in a way that it was designed, which would be you would hold the trade in exchange for when the price action closes on the opposite side of the 20. And then the second exit would be when the 10 period moving average closes on the other side of the 20. Now, the obvious question is, what happens if one crosses but the other one doesn't? Well, you're still in half the position. And then the second question is, what if it goes below the moving average and then goes back above? Well, you would put those shares back on. So there's a lot of different examples here that we can go through. But what it really comes down to is flawless execution of your system. And you can see here in Square, very similar trade. You would have actually got in here, got out here on half the piece, got back in here on both pieces, and then rode this up. And this is the beauty of a longer term moving average crossover system, a longer term trend following system. You'll have small losses in exchange for bigger wins. And that's, remember what I said before about winning trades versus losses, which should be viewed in your mind as a business expense. And again, we drill this home every single day, especially every single morning in the boot camp in our game plan meetings, which are every day at 8:30. I'm training everybody and helping everybody in the community think like a pro, which is the losses are okay if they're reasonable and acceptable for the profit potential, but don't get mad at the losses. Get mad at the trades that you had the big fish on the line, and instead of making 5,000, you made 1,000. It's those bigger trades that you need to learn how to make more money on, so that your trading business is generating more revenue in exchange for just paying those pesky losses. You know what this does psychologically? It sucks out all of the negative energy of losses. And you're like, all right, that one didn't follow through. And then you go to the next one. And I want to be clear, losing money stinks. Nobody likes to lose money. However, if you're going to run a business, you have to see it in this way. Otherwise, you're going to really be frustrated all the time that some trades lose money. I mean, if you're following a system where whatever system you have, like ours is order flow and tape reading, learning the correct entries and exits, the optimal entry, the right profit target. If you follow that system correctly and that system has an edge, you should not worry about those smaller losses, because the bigger losses, the trades that you hold, where we call building the argument, they'll more than offset those regular business expenses. So start to think about your trading account like a real business, which I know some people don't, some people do, but I want to, just throw that out there. And think about profits versus losses, and you'll start to see those small losses, if they're acceptable, are nothing more than part of running the business. And the next challenge for you, which is what we focus on every day in the boot camp, is understanding great ideas and when to hold them, when to size up, and when to do nothing. That's a big part of trading too. And I'm actually very proud of everybody in the boot camp. There was a little bit tougher day to trade yesterday, and we kind of scaled back and didn't get involved, which means now we're not going to be digging ourselves out of a hole because we were trying to pick a bottom. If the market turns around today, futures are, where are the futures right now? Futures are up neutral. But the key here is we're thinking long term. If you were patient yesterday and didn't overtrade and didn't try and pick bottoms, when the market finds a bottom and the trades become obvious again, you won't be digging out of that hole. You won't have big losses. You won't have big expenses. You didn't buy all this inventory that went bad. You're just making money. Now you're net profitable instead of digging out of that hole and getting back to zero. All of these things, that there's such a critical part of seeing your account go higher and higher and higher with reliability, but you need to follow them. You can't use pieces of it. You can't like read one chapter of a book and say, you know, the whole book, you know how to do everything. All of these little pieces, very similar to driving a car. That's what adds up to safe driving. And the same thing that comes out to predictable profits in the market is you have to use all the pieces. You can't just use some of them. So if you want help with this, definitely click down and learn and see what's in the boot camp. If you have questions about this specific strategy, definitely leave me a comment below. Have a great day, everyone.